Hello and welcome to Sectors Up Close. I'm David Pollard. Our focus today is US small caps, assets which some see as offering attractive opportunities. And our guest is Aoifinn Devitt, Chief Investment Officer at Moneta. Well, first let's get an overview of a sector perhaps best represented by the Russell 2000 index of 2,000 small cap US public companies. It has a market cap of just over $2.4 trillion. Year to date, and against a background of major sell-offs across share markets, the Russell 2000 is down just under 18%. There are ETFs too, including the iShares Russell 2000 ETF with a market cap of just over $52 billion. Its biggest holdings include Biohaven Pharmaceutical and Shockwave Medical. Financials are the biggest share of the holdings at nearly 25%, followed by healthcare and technology. 96% of holdings are in the US. Well, many investors see the potential for healthy returns in a sector that historically appears to have done well in a rising interest rate environment. Others think they might also benefit from their greater domestic exposure during a wave of slowing globalization. But small caps have underperformed on a relative basis compared to the S&P 500. So let's put that as our first question to Ethan Devitt, Chief Investment Officer at Moneta, which has over $28 billion of assets under management. Ethan, thank you so much for being with us today. So let's look at that first question. If small caps have been underperforming against some of the biggest benchmarks, why are they a good bet?
Well, we would say that diversification is always a good bet. Having a broad-based exposure to different cap sizes in a portfolio is always prudent. There are different return drivers, different factors, different exposures to having a long supply chain. As you mentioned, different exposure to a global market. So we would say that it's always good to have a diversified exposure. It's impossible to time when those sectors will outperform and underperform. So it's good to have that broad-based exposure at all times. And history tells us that after a sustained period of underperformance, that a period of outperformance then follows. And even though we're not technical analysts necessarily, looking back over time, it is hard to imagine that it will not again revert to the mean.
And you're one of those who believes that slowing globalization favors small caps. What is the thinking there?
The traditional small cap is what we used to think of as the mom and pop company. So something that maybe was small, only had a few branches, did not have exposure to global markets, was not a multinational, was not necessarily exporting. So would not have been exposed to currency differentiation. Remember, anything that is exporting now from the US will have that strong dollar. So that might be a factor in terms of its exports being more expensive. And also not having exposure to global markets means that anything that is hindering globalization, such as maybe transport issues, logistics issues, or even just a general protectionism, is not likely to affect those small cap stocks. They are domestically focused, though. They're not immune from a slowdown on the domestic front. I know we're going to talk about that in a minute.
And even supply chain constraints have been a major drag on bigger cap stocks. Why should smaller caps be any different?
If anything, actually, they might be more exposed to certain supply chain issues. The large cap stocks may have a vertically integrated supply chain and may therefore be able to ensure lock in perhaps a tighter logistics chain. And it could be that small cap stocks have absolutely no bargaining chip when it comes to the supply chain, and they might be more likely to be exposed to that. So that is a question mark. Of course, they don't tend to have long and complex supply chains, but there's definitely going to be an impact not only of that, but of rising input costs and all of the other inflationary factors will definitely erode margins in small caps, just like they will in large caps.
And today we've had a shock US GDP reading. Does that alter your view on the sector in any way? And how will it impact small caps?
Well, the interesting point is that the small caps have already adjusted to levels that we last see during a recession. So we're seeing the number of upwards earning revisions at an all-time low, at a level that we last see during a recession. We're also seeing some of the actual correction, not necessarily in the index, but in the top small cap stocks, be at a level that we've seen during recession. So I would suggest that already these have been priced in to small caps. So suggesting also that the upside surprise potential is greater, therefore. That's not to say, as we said before, these mom and pop operations are definitely going to be exposed to slowing consumer demand and to all of the rising input costs. They may have less pricing power. They are more vulnerable than large cap stocks in that way. But equally, they're not as widely held, so they're not as exposed to some of the momentum and the sell-off that we see in large cap stocks.
Okay, Aoifinn Devitt, Chief Investment Officer at Moneta. It's been great to have you with us. Thank you so much for those insights.
Thank you.
Well, before I go, here are some of the stories which have been impacting this space. And as we just mentioned, the US has today released the advanced reading for second quarter GDP. It shows a drop of 0.9% in the annualized rate of growth for the US. It's the second quarter of contraction and comes where economists had predicted a rise of 0.5%. A rising interest rate environment is seen as positive for small caps. This week, the US Federal Reserve raising rates by 75 basis points for the second month in a row. But unusually, Fed Chair Jerome Powell gave little specific forward guidance, leading some analysts to believe that the Fed may be about to pivot to a slower pace of rate hikes in the coming months. Along with today's growth numbers, one reason policymakers could be pondering such a move is a slump in US consumer confidence. The latest reading released this week shows confidence sliding to a near 1.5-year low in July. That comes amid fears over how high inflation is impacting spending. On the same day, shares in Walmart ended more than 7% lower after it cut its full-year profit forecast, blaming surging prices for food and fuel. And that is your roundup of the small cap sector. I'm David Pollard, and this is Reuters.